Welcome to the Explainer. Have you ever looked at your wallet and felt like your money just disappears faster than it used to? Well, today we're going to pull back the curtain and explain exactly how India's central bank, the RBI, pulls the strings that affect everything from your grocery bill to your home loan. So let's start with a feeling we all know, that little voice in your head that says, hey, didn't this cost less last year? You're not imagining it. Whether it's groceries, petrol, or rent, it really does feel like prices only know one direction: up. Well, that feeling has a name: inflation. You can think of it as this silent force that makes every single rupee you earn worth just a little bit less tomorrow than it is today. And that's the big idea we're going to unpack right now. Now, here's a twist you might not expect. A little bit of inflation is actually a good thing. Yep, it encourages us to spend and invest our money instead of just hoarding it. And that's what keeps the economy humming along. The sweet spot, according to the Reserve Bank of India, is right around 4%. The trouble really starts when that number gets too high. So, who's in charge of keeping that number in the sweet spot? Who's our financial guardian? Let's meet the main character of our story. Say hello to the Reserve Bank of India, or as we all know it, the RBI. It's the country's central bank, and believe me, it has a lot on its plate, from literally printing our money to managing the whole financial system. But for our story, the most important role it plays is as the monetary authority. Now, these huge decisions about interest rates, they're not made by just one person. They're made by a special 6-member group called the Monetary Policy Committee, or MPC. It's led by the RBI governor, and they meet every couple of months to, take the temperature of the economy. And this quote just hits the nail on the head. It really illustrates the massive challenge they face. If they pull the levers too hard to fight inflation, they could slow down the whole economy. But if they don't do enough, our savings start losing value. It is an incredibly delicate balancing act. So how does the RBI even begin to manage this tightrope walk? To get it, let's follow the journey of a single 100-rupee note. Let's say it's one you just deposited in your bank account. Okay, so you put your hard-earned money in the bank. You probably think it just sits there in a vault with your name on it, right? Nope. The bank's job is to put that money to work by lending it out. But here's the catch. They can't lend out all of it. The very first thing that happens is a piece of your money gets set aside because of a rule called the Cash Reserve Ratio, or CRR. This is a chunk of cash your bank has to keep with the RBI. And right now, that rate is 4.5%. So what does that mean? It means 4 rupees and 50 paise from your 100-rupee note is immediately locked away with the RBI. It's a safety buffer. Your bank can't touch it, can't lend it out, and this is key, it earns 0 interest on it. But wait, there's more. There's another safety net called the Statutory Liquidity Ratio, or SLR. This rule says your bank has to invest another portion of your deposit, but this time in super safe, easy-to-sell things like gold or government bonds. And this rate is currently set at a much higher 18%. So another 18 rupees from your deposit has to be put into these safe assets. Now, the big difference from CRR is that banks do earn some interest on this part. The main goal here is to make sure your bank always has access to cash it can get its hands on quickly, just in case a lot of people want their money back at the same time. Okay, so let's put it all together. After the CRR and the SLR are taken out from that 100 rupees you deposited, only 77 rupees and 50 paises is actually left for your bank to lend out as home loans, car loans, or to businesses. That's the crucial takeaway. So we know how much money banks can lend. But how does the RBI influence whether they want to lend, and at what cost? Well, let's look at the main levers it uses to steer this giant economic ship. All right, this is the big one. This is the term you hear on the news all the time, the repo rate. To put it simply, it's the interest rate your bank pays when it needs to borrow money from the RBI. Think of it as the wholesale cost of money for your bank. And on the flip side, you have the reverse repo rate. This is what banks earn when they have extra cash lying around and decide to just park it with the RBI. It's basically a risk-free savings account for banks. This slide shows the push and pull perfectly. Think of it like this. The repo rate is the economy's accelerator. When the RBI lowers it, it's encouraging banks to borrow and lend more, speeding things up. The reverse repo rate, that's the brake. Raising it makes it more attractive for banks to just save their money with the RBI instead of lending it out, which slows things down. Okay, that's all very interesting, but why should you care about these complicated rates being decided in Mumbai? How does any of this actually hit your personal budget? Let's connect the dots. Here's the chain reaction step by step. When the RBI hikes the repo rate, it gets more expensive for your bank to borrow money. To protect their profits, what do? They pass that cost on to you. Suddenly, the interest rates on your home loan, your car loan, they all go up. Your EMIs get bigger. But there is a silver lining for savers. Your fixed deposits will probably start earning you a little more interest. And this chart just boils it all down. A high repo rate, it's tough for borrowers but good for savers. A low repo rate, it's the other way around. Loans get cheaper, but your savings don't earn as much. It's this direct trade-off that the RBI is constantly trying to manage for the entire country. And that leaves us with the million-dollar or maybe trillion rupee question that economists and policymakers wrestle with every single day. Finding that perfect balance between keeping prices stable and keeping the economy growing is the ultimate challenge. And now that you know how the tools work, you can follow the debate right along with them.